Welcome to CoreLogic's Housing Market Update for August 2020, brought to you by onthehouse.com.au. Last month we saw Australian housing values rack up a third consecutive month of declines, with CoreLogic's Home Value Index dropping by 0.6% over the month. This was a slight improvement from June, when the national series was down by 0.7%. Across the capital cities, only Canberra, which was up 0.6%, and Adelaide at 0.1%, posted a rise in dwelling values over the month, while in Melbourne, which was down 1.2%, and Sydney, down 0.9%, led the declines, recording the largest month-on-month falls in July. Regional markets are generally showing more resilience to falling values. Across the combined regional areas, housing values were unchanged in July, compared with a 0.8% fall across the combined capital cities. Regional Victoria, where values were down by 0.5%, and regional WA, which was down 3.2%, were the only non-capital city markets to record a fall in values over the month. The impact from COVID-19 on housing values has been relatively orderly to date, with CoreLogic's national index falling only 1.6% since the recent high in April, and housing turnover has recovered quickly after its sharp fall through late March and April. Record low interest rates, government support and loan repayment holidays for distressed borrowers have helped to insulate the housing market from a more significant downturn. Additionally, advertised supply levels have remained tight, with the total number of properties for sale falling by a further 4.3% in the 4 weeks to July 27th, sitting 15% below where they were this time last year. Additionally, increased demand driven by housing-specific incentives from both federal and state governments, especially for first home buyers, have become more substantial. New listing numbers continued to rise through the month, up 46% from the recent lows of early May, to be slightly higher than a year ago. The rise in fresh listings implies that homeowners have become more willing to test the market. While new listings are ramping up, the total listing count remains 15% below last year's level nationally and 12.5% lower across the combined capitals. The diverging trend between new and total listing numbers implies a strong rate of absorption, where the demand for established housing stock is outweighing advertised supply. In line with the strong rate of absorption, sales activity has trended higher since May. After home sales plunged by about a third in April, sales activity has consistently improved. CoreLogic estimates for national sales over the past 3 months were tracking 2.9% higher than at the same period in 2019. The rebound in CoreLogic estimates of sales activity is validated by the strong rate of listings absorption, a similar lift in purchase-related valuations, and improvements in consumer sentiment. However, the recent slump in sentiment amidst a new wave of the virus could interrupt the rise of home sales until restrictions are lifted and confidence returns. Additionally, auction markets showed a temporary recovery through June and early July, but have since weakened as Melbourne moved back into lockdown. Auction volumes have been tracking higher than a year ago since late June, and auction clearance rates were hovering around the decade average of 61% since the second week of May. Since early July, clearance rates have trended lower due to a substantial rise in withdrawn auctions across Melbourne. Perth's rate of decline eased in July, with values down 0.6% over the month, following a 1.1% drop in June. The reduced rate of decline comes as sales activity rebounds from the recent April low. There is very little difference between the performance of houses and units, with houses down 2.2% over the rolling quarter, while unit values were down 2.1%. The past 3 months have seen our estimate of sales activity recover to levels that are slightly higher than the same period a year ago, but still down on the long-run average. Total listing numbers remain 26% lower than last year, despite new listings tracking almost 13% higher than a year ago. The shortage of advertised supply is another factor keeping a lid on turnover. Rental markets have also tightened, with CoreLogic's rental index rising 1.3% since March. This is the strongest growth in rent values across the capital city markets since the onset of the pandemic. In summary, housing markets have weathered the COVID storm much better than we originally anticipated. So far, the decline in home values has been orderly, with only modest reductions in most areas. Turnover has recovered quickly and is tracking higher than a year ago, at least at a national level, although that is a relatively low benchmark, where this time last year we were moving through the trough of the previous cycle. However, demand is evident as advertised stock levels are being absorbed faster than fresh stock is being added to the market. The unprecedented level of fiscal support from the federal and state governments, distressed borrower repayment holidays, and record low interest rates are the key factors supporting demand and insulating home values. While interest rates are set to remain at their current lows for the foreseeable future, the government's fiscal response will start to taper in October, and repayment holidays are set to expire at the end of March next year. The removal of this support will test the market's resilience. As stimulus measures wind down and mortgage repayment holidays can no longer be extended, it's logical to expect a rise in distressed properties coming onto the market. The extent of which this causes additional downwards pressure on home prices depends on how the Australian economy is travelling at that time. Further virus outbreaks present a clear and present danger to the depth and length of the recession and the performance of the housing market. To stay up to date with the property market's performance in a rapidly changing environment, you can tune into regular research updates from CoreLogic at www.corelogic.com.au.